This video will measure financial leverage ratios for Coca Cola, stock symbol KO, and Pepsi Cola, stock symbol PEP, over the period 2012 through 2016. Alright, financial leverage ratios generally measure the relationship between liabilities and equity in the capital structure of a company. Remember, assets are equal to liabilities and equity. So as the proportion of liabilities gets higher, it means that there's more financial leverage in the firm. All right, financial leverage simply means the higher proportion of liabilities. The higher the proportion of liabilities, the greater the risk. And that's not necessarily good or bad, but it's important to understand what the level of risk is with respect to financial leverage and whether it's changing or not. All right, the first one we look at is the debt ratio. The debt ratio is simply total liabilities over total assets. So it's measuring liabilities as a proportion of assets. So we see here with Coca Cola, the assets are about 75%, or the liabilities are 75% of assets, so the equity be the other 25%. We see a change. It was about, in 2012, you're looking at 62, 63, 67, 72, 74%. So the liabilities as a proportion of assets have been increasing. And we see the same pattern over here in Pepsi, but Pepsi's financial leverage is actually higher. If we look in the financial statements, there's two ways that can happen. One is that if the assets are decreasing while the liabilities stay the same, you'd see that pattern. Or if the liabilities are increasing while the assets are staying the same. What we see with both firms is assets are fairly stable. Coca-Cola's is right around close to $90 billion, and averages $90 billion for the period. But look what's happening with the liabilities. The liabilities are increasing. So it's not that the assets are getting smaller, it's that the liabilities are increasing and the assets are fairly stable. And we see a more dramatic increase, a $10 billion increase over here for Pepsi Cola, from $52 billion to $62 billion at the time when the assets have stayed, looking from 2012 to 2016, right around $75 billion. So that's our explanation of why the ratios are changing, is that the denominator, total assets, has not changed. What has changed is they are increasing the absolute amount of debt on the balance sheet. All right, the equity multiplier measures the same thing. It just, instead of taking liabilities divided by assets, it takes assets divided by equity. All right, so measuring the same thing, financial leverage, we just do it a different way. And the higher the debt ratio, the higher the financial leverage, the higher the equity multiplier, the higher the financial leverage. The debt ratio and the equity multiplier are actually related to one another. So if you know one, you can compute the other. For instance, we have here an equity multiplier, assets per dollar of equity, of 3.78. All right, so if that's equal to 3.78, that means there's $3.78 of assets for every $1 of equity. So if I write that out in my equation, that would be $3.78 of assets are equal to liabilities plus $1 of equity. So that would mean that there's $2.78 of liabilities for every $3.78 of assets. So if I know one of these ratios, I can actually compute the others. So that'd be $3.78 of assets would be $2.78 of liabilities plus $1 of equity, and the debt ratio, which is liabilities over assets, would be 2.78 divided by 3.78, and that would come out to 73.6% with rounding. All right, so measuring the same thing there. We have another ratio here called the total debt to total capital. And what that does, the total debt to total capital is talking about interest-bearing debt. So that would be the sum of short-term debt, interest-bearing debt, and long-term debt divided by the total capital, and the total capital would be the short-term debt plus the long-term debt, the interest-bearing liabilities plus the shareholders' equity on the balance sheet. So that's measuring something similar, but it's using the costly capital as opposed to the things like accounts payable or deferred taxes liabilities. So it's measuring the stuff we actually have to pay a specific cost for, and as we would expect, it's also getting higher, and it also shows that Pepsi is higher. The times interest earned ratio is a measure how well we cover it, how much income we have to actually cover the interest expenses associated with the debt. And that would be operating income, or earnings before interest and taxes, divided by interest expense. All right, in EBIT, or operating income, where it's earnings before the interest expenses and taxes divided by the interest expenses. So it's how much before you pay the interest divided by how much interest you have to pay. And we see that for both firms that number's been going down, although it's still pretty hefty. There's $11, $12 of earnings to pay all the interest expenses over at Coke. There, you also see a decrease over here in Pepsi, but there's still $7 of earnings to pay for every dollar of interest. Now the cash coverage ratio takes the same calculation, except that it adds back depreciation for the operating income. So it's earnings before interest and taxes, but add back the depreciation expense, because depreciation isn't really a cash expense, so it's a matter of cash flow available to pay interest expense. All right, so similar concept. What we can see here, though, is if we go to the financial statements and go up to the income statement, what it's measuring is operating income in this line divided by interest expense in this line. That is the times interest earned ratio. And then the other ratio simply add back the depreciation expenses. So we can see, though, that they have a healthy amount of income available to pay the expenses. The interest expenses have been going up for Coca Cola. In fact, they've almost doubled over this period, but they still have a big pile of income available to pay the interest expenses. Pepsi's have gone up even higher. Part of that would be the mixture of debt and the type of debt. With Coca Cola, if you reflect on the video on the common size balance sheet, Coca Cola has a higher mix of short-term debt, short-term interest-bearing debt, to its long-term debt. So between the long-term debt and the short-term debt, here we're looking at about $46 billion, $45 billion, $40 billion, etc. But a chunk of it is short-term debt. Short-term debt has a lower interest rate. Pepsi has short-term debt, but it's a much lower proportion than Coca Cola, about a sixth of it. So we see that reflected partly in the interest expenses. Interest expenses on long-term debt are going to be higher than interest expenses on short-term debt. The bad news about using a lot of short-term debt is that the interest rate can go up more quickly because you have to refinance it constantly. At least once a year, you have to reborrow the money, and interest rates can change a lot in a year. Long-term debt, you've locked in an interest rate over a longer period of time, which makes it more predictable. All right, so in any event, that's where we get these financial leverage ratios for both firms. Pepsi has higher financial leverage, uses more debt financing relative to its assets than Coca Cola.